on the Billion Dollar Trap, where we're going to unpack exactly how credit cards quietly consume wealth and how we can completely rethink that simple tap. Now, imagine that same exact $5 coffee sitting on a credit card statement. Except because the balance wasn't paid off right away, that coffee quietly inflates to $6. And then, a few months later, it becomes $7. Give it a bit more time, and you've essentially paid $8 for that one single cup. And it certainly wasn't because the barista added gold flakes to it. It's simply because compounding interest kept growing month after relentless month. This invisible inflation is happening right under our noses every single day. And the truth is, this isn't just a story about one person buying a coffee. This is the silent reality for literally millions upon millions of consumers. The sheer scale of this is just staggering. $1 trillion. To put that into perspective, today, Americans owe more than $1 trillion in credit card debt. Every single day, thousands of people are slipping deeper and deeper into this debt pool without ever fully realizing how the underlying system actually operates. The truly shocking part of our modern economy isn't simply that people borrow money to get by, right? No. The shocking part is that major banks have intentionally built an entire business model where your consumer debt serves as one of their primary sources of massive, massive profit. Section 1, the cashless revolution. And this brilliantly illustrates exactly how we got here. You see, long before these plastic cards existed, our economy ran almost exclusively on cash. The rule was beautifully simple. If you didn't have the physical money in your pocket or in your bank account, you simply couldn't buy the product. Your spending had a strict natural limit. But everything changed in the middle of the 20th century when banks had a powerful realization. They figured out that if they allowed people to, buy first and pay later, consumers would spend significantly more than they normally would. Almost overnight, families were buying televisions, new furniture, and extravagant vacations with actually having the cash on hand. It was the invention of credit, and it literally changed how we consume forever. Section 2, the psychology of spending. To truly understand this trap, we really have to look at the fascinating neurological science behind our habits. It all comes down to a concept called the friction of spending. Researchers actually found something pretty remarkable. Paying with physical cash activates a strong feeling of loss in the human brain. When you physically hand over a $20 bill, your brain immediately registers the cost. It literally feels a type of psychological pain. But, and here is the dangerous part, when you simply tap a piece of plastic or use a digital wallet on your phone, that natural friction is dangerously bypassed. That feeling of loss becomes incredibly weak. You simply spend more when you don't physically feel the money leaving your hands. Now, the banks understand this human psychology intimately. They know your brain doesn't register the pain of a card swipe, so they layer on extra incentives to make swiping feel incredibly rewarding. Just look at these psychological hooks: reward points, cashback, travel miles, massive welcome bonuses. The fascinating thing here is that these offers aren't acts of generosity from financial institutions. No way. They are meticulously designed features deployed for one specific purpose, and that's to actively encourage you to spend more. Because, well, the more you spend, the higher your balance goes. And it's not just the banks, right? Companies and advertisers use this exact same psychology to mask the true cost of the items you're buying. They don't just sell you a price tag, they sell you what we call the lifestyle illusion. They heavily market luxury, freedom, success, and status. They prey on our emotional triggers. Think about it for a second. How often do people swipe a card because they've had a really stressful day at work, or because they're celebrating a milestone, thinking, oh, I'll just buy this now and worry about the bill later? The whole system is designed to make that momentary feeling of buying something new override any logical concern you might have about the long-term cost. Section 3, the minimum payment trap. Unfortunately, that buy now, worry later mindset eventually catches up to us. Let's walk step by step through a highly relatable scenario to see exactly how this mathematical trap springs shut. Imagine you purchase a $1,000 laptop on a credit card. Okay, step 1, you buy it on credit and you take it home. Awesome. Now, step 2. When the bill arrives at the end of the month, instead of paying the full $1,000, you decide to make only the minimum payment. At first, maybe that's just $25 or $30 a month, and it feels completely manageable, right? But then comes step 3. Because you only paid the minimum, the remaining balance gets hit with interest, and that interest continues to grow month after month, year after relentless year. So what originally cost you $1,000 ends up costing you significantly more. The price tag basically balloons wildly depending on your interest rate and how slowly you repay. So the crucial point is exactly what financial experts emphasize. Minimum payments protect the bank, not the customer. It's a really profound realization when you think about it. Making that minimum payment feels like you're being a responsible consumer and staying in good standing. But all it really does is keep your account active so the bank can continue compounding and profiting off your interest. When you multiply this exact laptop scenario by millions of households all across America, well, those small, seemingly harmless monthly interest charges suddenly combine into billions of dollars in industry profits. Section 4. The Wealthy Mindset. Now, it's really important to note here that credit cards aren't inherently evil. When used responsibly, they're actually great tools for building your credit history, booking travel safely, and protecting your purchases. The secret lies entirely in changing how you view them. Let's look at the emotional spender. That's someone who falls into the trap of swiping out of stress, celebration, or just the illusion of future wealth. But compare that to financially successful people, the intentional spenders. They don't look at a credit limit as free money. Actually, scratch that. They view cards strictly as payment tools and nothing else. An intentional spender pays their entire balance every single month. By doing this, they completely avoid interest. They scoop up all those travel miles and cashback rewards without ever paying a single cent in unnecessary finance charges. They essentially flip the script. They make the system work for them instead of becoming trapped by it. Ultimately, money itself is completely neutral. It's neither good nor bad. It simply follows the rules created around it. The people who take the time to actually understand those rules gain a massive advantage, while those who ignore them end up paying the price for years to come. So the next time you pull out your credit card, I want to challenge you with this final provocative thought to take away from this explainer. Ask yourself, am I buying this because I truly need it, or because the system has quietly convinced me that spending feels better than saving? Mastering that single question could save you thousands of dollars over your lifetime. Because true financial freedom doesn't begin simply by earning a higher salary. It begins with understanding how the rules of money actually work. Keep that in mind next time you go to tap your card.